Leaving a job, retiring, or switching financial advisors triggers a mountain of paperwork. You sign a few forms to move your 401k or IRA, expecting the funds to make a simple transfer to your new account. Moving retirement money is a high-stakes tax event. One wrong box checked on those transfer forms can trigger taxes and penalties that wipe out a massive portion of your savings. Financial institutions will offer you a menu of options to move your money: transfers, direct rollovers, and indirect rollovers. They present these choices neutrally, rarely warning you about the specific tax liabilities attached to each one. The destination of your money does not determine your tax risk. The specific mechanism you use to move it does. To navigate these rules, you have to look at your specific financial scenario. The first scenario is the standard job changer. You have a typical retirement account filled with basic mutual funds or cash, and you simply want to move it to a new provider. The second scenario is the company stockholder. You have a 401k that holds highly appreciated stock from your employer, and you need to preserve the tax advantages of that specific equity. The third scenario is the mistake maker. You have already requested a payout and currently have a personal check from your retirement account sitting on your kitchen table. Applying the rules for a standard job changer to a company stockholder guarantees a severe tax penalty. You must match your strategy to your exact situation. Let's start with the safest mechanisms. A transfer occurs when you move money strictly between identical account types. For example, moving funds from one traditional IRA directly to another traditional IRA at a different bank. Transfers are completely invisible to the IRS. Because the account type never changes, there is no tax reporting required, and you can execute as many transfers as you want whenever you want. A direct rollover operates differently. This mechanism is used when you move money between different account types, such as rolling an old 401k into a traditional IRA. Because the money is changing account categories, a direct rollover triggers an IRS Form 1099-R. Form 1099-R is an official tax document used to report distributions from pensions, annuities, and retirement plans. You have to file this form at tax time to prove to the IRS that the move was a non-taxable event. Despite the extra paperwork, transfers and direct rollovers share one critical feature: the money moves directly between financial institutions. Because the funds never touch your personal bank account, you avoid the risk of early withdrawal penalties. The danger arrives when you choose an indirect rollover. This happens when you elect to receive a distribution check made payable to you personally, giving you 60 days to deposit the funds into a new retirement account. People often use this as a temporary 60-day bridge loan. If that money comes from a 401k, your $100,000 distribution hits a mandatory 20% IRS withholding trap. The total splits: an $80,000 block sent to you and a $20,000 block diverted directly to the IRS. To avoid taxes, you must deposit the full $100,000 into a new account within 60 days. The $80,000 moves into a new bucket, but you must replace the missing $20,000 out of pocket. If you cannot cover this gap, the IRS treats it as a permanent taxable distribution, plus a 10% early withdrawal penalty if you're under age 59 and a half. If you are moving money from an IRA instead of a 401k, there is no mandatory 20% withholding, but you face a different trap: the once per 365 days limit. The IRS strictly limits you to one indirect IRA rollover per year. If you attempt a second indirect rollover within that 365-day window, the IRS classifies it as an excess contribution. This triggers a 6% penalty on that money, compounding every single year until you formally correct the error. Taking a 60-day personal check exposes your retirement savings to mandatory withholdings, rigid deadlines, and compounding penalties. The short-term liquidity rarely justifies these risks. There is a strict exception to the rule that direct rollovers are the best path. This applies exclusively to the company stockholder, individuals holding highly appreciated stock from their employer inside a 401k. If you execute a standard direct rollover, moving that stock into a traditional IRA, you convert all future gains on those shares into ordinary income. When you eventually withdraw the money, you will pay taxes at your highest standard tax bracket. To avoid this, you use the net unrealized appreciation, or NUA, strategy. This provision lets you pay capital gains rates on the growth of employer stock. NUA divides your stock's value into two parts: a small bottom segment representing your original cost basis, and a massive upper segment representing the appreciation. You distribute the stock into a taxable brokerage account, paying immediate ordinary income tax only on the small cost basis. When you sell, the accumulated growth is taxed at the lower long-term capital gains rate, saving you a massive percentage. For company stockholders, choosing a standard direct rollover for administrative simplicity destroys an irreversible tax advantage. You must use NUA to protect your equity gains. Let's address the mistake maker. You initiated an indirect rollover, received a personal check, and missed the 60-day deadline because the bank delayed the transfer, the mail was lost, or you suffered a sudden illness. You can implement an immediate legal fix using an IRS self-certification letter. You write a formal statement to the receiving financial institution detailing the exact qualifying reason you missed the window. Utilizing this self-certification bypasses the need to apply for an IRS private letter ruling. A private letter ruling is a formal, written decision by the IRS interpreting tax laws for a specific taxpayer's situation, which costs $10,000 just to file, with no guarantee of success. There is a trade-off to this free fix. Self-certification leaves you entirely open to future IRS audits. You must maintain pristine, permanent documentation proving exactly why the delay occurred, ready to present if the IRS investigates. While this rescue option exists, relying on IRS leniency is a dangerous fallback plan. It is far safer to secure the proper transfer mechanism from the beginning. Let's lock in the rules for our 3 archetypes. Take a look at this chart. We have a 2x2 evaluation matrix mapping tax safety on the vertical axis against effort and complexity on the horizontal axis. We plot the indirect rollover in the bottom left quadrant. It requires low effort but provides low safety, bringing the constant threat of withholdings and penalties. For 90% of people, the standard job changers, you demand a direct rollover or a transfer. This sits in the top left quadrant as the glowing default choice because it pairs minimal administrative effort with complete tax safety. For the optimizer holding company stock, you must utilize the NUA strategy. Plotted in the top right, it requires high effort to execute the specific brokerage transfers, but it yields high safety and maximizes your tax advantages. Protecting your retirement savings requires precise execution. You secure your wealth by choosing the specific transfer mechanism that strictly matches your asset profile.